Vikas, good morning. Thank you for joining us. Aisha and me were discussing that it's getting so hard to predict. I mean, when you look at crude, 98 became 135, 135 became 100, 100 has become 120. If crude can behave like a mid-cap stock, I wonder what is in store for the broader market.
I think because we definitely are in uncertain times. I think before the war kind of situation arose, the supply chain disruptions were anyway there, and they were not normal. And I think war has only added to the woes. And of course, around the crude, there is lots of uncertainty going. So that's joker in the pack, and that's where right now most of the worries are. But the surprising part is that despite all those worries, markets are holding on pretty well. I mean, it's showing reasonably good resilience, I would say. So, but yeah, I mean, one can never, these are the uncertain times, and uncertainty is likely to prevail. I think many people have predicted war will get over soon. It has not. So I think these are the very unpredictable situations, and one should never try to kind of, in my opinion, predict, because this is very outside the domain of anybody for that matter, in my opinion. So all you have to do is you have to be sort of be able to withstand this, and keep doing the basic thing. Businesses which are going to benefit from something like this, businesses which are structural in nature, you might get because of these uncertain times, at a reasonable valuation, at a right valuation. So I think that's the best thing to do in times like this, rather than every day looking and watching crude oil price, because there's nothing you can do about it.
Because we have a lot of common friends, and some of our common friends are big macro callers, and they are of the view that, look, this kind of an energy shock means that the world is headed towards not slowdown, but world is headed toward recession, which is bad for equities, which is bad for businesses, which is bad for earnings. How much of importance do you think one should give to the macro right now? Because we don't know what will happen, and if we don't know what will happen, then macros will deteriorate, and which will have an impact on the broader setup.
So because I think again it is macro assumes that oil will stay at $150 or $200, right, or whatever. If that is that turns out to be true, so I don't know what's the probability of that, but if that turns out to be true, I think it will have a impact on a global economy. But the fact of the matter is that we can all kind of have different probability, but nobody knows where it's going to be, right? So outcome will be dependent based on what happens. The only probably my two bits on this, and I'm no expert on anything, is that there are two biggest consumer of oil, or driver of the growth in the oil demand, which is India and China, right? And both have, in some sense, sort of access to Iranian as well as Russian oil. If suppose worse, comes situation, and I think they both countries have shown the willingness to have a direct rupee trade or local currency trade with them, and which is kind of going to help us sort that out. So I think there are still things are unknown. So one does not know. This is again my two bit, but I think that the probability of going to 150 or 200 and sustaining there is low. But you never know in these kind of situations. Anything can happen. We have to just sort of watch out. But I think from India's standpoint of view, even if let's say things were to kind of go wrong for some time, I think those structural drivers which we have spoken many times often, they don't change. They have remained here. I mean, just think about it. When the oil went to $10 or negative, I think most people wrote off that oil will never come back to $30, $40, right? So that was the kind of narrative, and all macro experts said that, right? That oil is dying, and same thing, we are seeing changing in no matter less than 2 years time, where we are talking about $150, $200. Now just think about it. These things are very, very hard to predict. But only thing I believe that both sides can't sustain for long, neither at $10 nor at $150, because somewhere the reality is in between from a structural perspective, sustainable perspective. If world were to go into recession, probably demand will slow down, right? So I personally believe that one can't do much about it, but one has to withstand. And I don't think at least India is far more insulated from in this time of the cycle from lots of things happening around.
Good morning, Vikas. This is Nantara. We hosted you about 4 weeks ago, and that's when you told ET Now investors should not be impulsive, a point that you're building upon right now, saying that will banks stop doing business here, or IT services not go up simply because of this big macro event. You had then said you were going to wait for dips to buy in. Can I ask you that given the recent correction that we had, which were some of the stocks that you decided to enter?
So again, so I think we have been, sort of buying similar stocks, themes basically, and within those themes, like I think we have spoken in the past, manufacturing is a very big theme for us, especially where the shifts are happening from China, and also the local domestic manufacturing has picked up very well, where we have added two stocks to our portfolio, which is JK Paper and PCBL, and both of them are structural in nature. No new capacities are coming, capex is behind, industry cycle is in your favor, and where we are sort of beginning to see over next 3-4 years a very nice cash flow cycle playing out, and the risks to the cycle is low even in the current environment. Demand cycle is reasonably well in place. So I think these kind of niche and ideas you do get. So that's what I'm saying. Rather than getting sort of carried away by the noise which is all around happening, if you just focus on your fundamentals, on your basics, and keep doing that, it might happen the stocks you buy might have gone down 10% after you bought, but that would happen any day, right? You can't do much about it. But we are quite confident that some these kind of play where there's some more, the capacity shifts are happening, they will eventually be the winners. And those shifts, in my opinion, I will assign very insignificant probability to those shifts reversing, because they are in my opinion irreversible, and hence we are kind of playing on them, and we think in a fullness of time we will kind of play out them very well. So basic things don't change. It's just that you kind of keep on finding newer and newer spaces which are beneficiary of this.
Because we're also talking on a day where, for obvious reasons, Kotak Bank is going to be in focus. You have ICICI Bank as well as Kotak Bank in your portfolio. Parallels are being drawn between the two. SBI gave phenomenal returns last year. Everybody's waiting for HDFC Bank's comeback as well. How are you positioning yourself when it comes to the private sector lenders?
So, like you said, that we have two large banks in our portfolio, namely ICICI Bank and Kotak Bank, and we believe both are incredible franchises. And they are I mean, we believe that large private sector banks have a lot of things going in right for them, from a balance sheet perspective, from a CASA perspective, even their ability to lend at a cheaper cost to the, so from all perspectives, investment in technology perspective. So I think, and both these banks, we believe that are in for anywhere between 18 to 20% kind of annualized growth over the next 5-7 years, and both are run by exceptionally good management teams. So that gives us the confidence, and we will play it out. I mean, these kind of moments would come. Some stocks will underperform in a particular period. Some stocks will outperform in a particular period. That does happen in our markets. We have seen over the years, and so these are the two names which we have. But having said that, even Axis will do well, even HDFC Bank will do well. So because the tailwind and banking sector is coming out of a reasonably long period of consolidation, and so I think banking is in a reasonably good phase, and private sector banks and some of the large PSU banks like SBI would benefit from this over the next 3 to 5 year cycle. We are just at the cusp of beginning of a credit cycle. So go back and see what happened in 2004 or 5 when the credit cycle had picked up. So those kind of situation can play out again, in my opinion. And that's how our confidence in the sector remains very high.
Because I had Ramesh Damani, a very common friend of ours, on the show yesterday, and I said, Mr. Damani, how are you making the nest egg for your grandchildren? Now I know you don't have grandchildren, but you got two lovely daughters. So let me ask you this question, that how are you making the nest egg for your daughters? That these are the 4-5 stocks, I would say, I'm buying it not for my retirement, but I'm buying it for my daughter's education. Not that you need that much, but still, as a father, I'm showing you doing your duty.
I'm just getting them to invest into Carnelian funds, because that's what we do all the time, right? Which we keep investing into high quality businesses. And as long as we are investing right businesses, and that's what we do for living also, right? So their money keeps on coming in our funds, and hopefully, by the time I retire or as Carnelian grows, I'm sure, their money also will compound and they will be self-sufficient. They won't need me.
It's a good answer. It's a very nice answer, but if they say that they have to diversify their risk, they don't want to keep the risk all in the house.
My wife
they say diversification is important.
They don't have a choice. They have to.
But Vikas, I was just digging out what we spoke about in 2020, and this is a conversation from August 10. Quite interesting. Hear this out. You said that you're seeing economic pickup on ground level, that low interest rates will be a big trigger. Now that scenario has completely changed. While economic recovery has been steady, interest rates are not. Just wanted to understand, what does it then spell for rate sensitive sectors? Do you change your investment theme in any way based on this?
Absolutely, very good question. So I don't think we are in a structurally upward interest rate cycle, according to me, as far as India is concerned. Of course, in US interest rates will go up, but I have said, I think in our previous conversations, that this time around interest rate cycle in India will be very, very benign. Of course, when the inflation goes up, we will see somewhat hardening, and which has happened by whatever 50 basis point, 75 basis point in last 1.5, 2 years. So that would happen. But good part about it this time around, because we are getting into a structural positive current account surplus kind of situation in over next 3-4 years. And if that sustains and that turns out to be true, India's ability to maintain or manage interest rates locally will be far more better placed. If we have this time around more and more manufacturing picking up locally, our ability to manage inflation will be far, far more better placed than it has ever been. So these parts give me a lot of confidence and India has a lot of saving pools. So it's not that India does not have saving pool. So when we don't need external capital for our growth and sustenance, then we don't necessarily have to get pegged with the rising interest rates globally, right? So I see a situation in 3-4 years time as we kind of build our current account surplus, which is I think nicely kind of improving. Our exports are improving. Our IT services exports are improving. Current accounts balance is getting better and better. So then it will give a lot more leeway to RBI to manage interest rate, in slightly benign. Accept the fact that if tomorrow some development happens when inflation just gets out of hand. Let's say we had 10% for some reason. Those are the very, very different situations, which I don't see at this point in time. But otherwise, I think our ability to manage interest rates locally without having too much of impact coming from overseas would be far, far higher than it has ever been in the independent history of India. And that's what gives me a lot of confidence. Minor inching up of interest rate never harms. I don't think 50, 100 basis point will harm in a big way. But I don't see a scenario where the structural upward trajectory on the interest rates happening.
Yes, interestingly, you'll be quite intrigued to know this. So I'm just reading your takeaways from 2020. You said techs will do very well in next three to 4 years. IT companies will get re-rated. That's already played out. We just chatted about that. You said beaten down realty sector will do very well in the long term. That trade as well has played out. You said remain structurally positive on specialty chemical companies. That as well has played out. And you also talked about Reliance Industries, saying that players like Jio can benefit in a big way from the work from home environment. Having said that, while Reliance definitely had its time under the sun, off late it's sort of gone into a bit of a consolidation zone, 2300 to 2500 thereabouts, still a little far away from its 52-week high. Wanted to understand, what's the take on Reliance? Will it now be a patience game? Will one have to really wait it out to see those 2020 kind of gains when Facebook, etc. invested in it?
So investing is obviously a patient game in any stock, and I think Reliance kind of stock, in my opinion, if you see 2009 to 14 period, Reliance gave zero return or very small return, right? And then it gave return in spurt. I think my confidence in Reliance always comes from the fact that Mr. Mukesh Ambani is, in my opinion, exceptionally is a great business leader. I think one of the few in the whole world, I guess. And if you have, and what businesses they have created, whether it is on the petrochemical side or on the geo side, or on the retail side, and now next what they're talking about is on hydrogen side. In my opinion, I mean, you get very few entrepreneurs like this in country, and he's a national asset according to me. So from that perspective, I think I'm quite positive on Reliance as a stock, because the kind of sheer assets they have created, and which has of course created value for the shareholders as well. So there will always be periods of that all kind of rumors fly. That so there could be periods of these kind of drawdowns or consolidation. I see them as an opportunity, because I think if you see petrochemical cycle is in their favor, refining margins are in getting into a golden era of refining margins. Petrochemical cycle is in your favor. Geo, I think I mean, we all know that there's no other alternative. There are only three-player market, and it only gets better from here. Retail, they are doing pretty well. And if something like hydrogen, if they are able to create sort of disruptive sort of technology and deliver at $1, I think it can be a game-changing event not only for Reliance but our country as well. So, which he has commented publicly in so and I give a lot of credit when MDA comes and speak because he does not do stock. So I think if you have that kind of setup and the balance sheet is reasonably well placed, so I personally feel that that's the one stock which will continue to kind of, despite all its skepticism, which has gone down over the years, but will continue to surprise investors, and there will be spurts in which it will perform, and that's how at least we look at it.
Because what we saw, of course, recently was hammering not just in India but globally of the consumer tech stocks. In recent times, some of the consumer tech stocks have started to do better at a time when there's this whole discourse taking place that you need to move towards value versus growth stocks. Paytm, however, I would like to point out, is still below 550 rupees a share and a big stress point. The new age companies, what's your strategy? Did you use recent dips maybe to buy, to accumulate?
Not really. I think, if since you referenced some of my newsletters last year, we wrote in the middle of when the new tech was at its peak that, we wrote a letter saying fade, FOMO fade. So this fad will fade away. People are acting out of fear of missing out. And whenever investors start doing that, out of, that psychology, we know that it's close to peak of bubble, right? And that's what has happened. According to me, many of those companies, and I said this publicly, I think one of the channels that I have done banking all my life, right? All, people, IPOs which went public, in that phase, probably many of them won't exist in 5 years, 10 years down the line, and many of them will erode serious value, right? So whenever this kind of frenzy is there, idea is to always stay away. And I do believe that many of the new tech companies don't even have a robust business model. So we would stay away from that. Of course, it's not that we are blind to the disruption, but we also don't want to get bought into overplaying of this disruption theme. Sometimes I feel markets have overplayed this disruption themes. Of course, you have to constantly keep watching out. Business models are evolving, and some of them are incredibly good businesses. So I'm not making that point that they're bad, but you've got to be very mindful. As an investor, our job is to make money from a risk reward point of view, not to be part of every party and just hang around there. So we have stayed away, and I still think that there's a fraud. I still don't think that it has got sort of cleared big time. So we will watch out. I'm not saying that we have not bought so far anything, but we're watching out everything.
Since Aisha and Nantara have this great habit of taking all the interviews clock back, I just remember that there was a time when Vikas was also a banker. So the question on IPOs going public, was that answer from Vikas the investor or Vikas the ex-banker? I got you there.
I also heard during the break, Vikas, that you've been for Vipassana too. How was that experience?
I mean, that, in my opinion, is a phenomenal experience. I would say, I mean, not only in investing in anything, how we carry out our life. I think India has some unbelievable techniques in terms of we evolving as a human being. And I recommend every person to go and experience that. It's a 10-day program. Whether you believe it or not, it's no sort of religious thing. It's just a meditation technique taught by Gautama Buddha. And I wrote a sort of again blog post on that as well. It was one of the best experience of in my life, and it has materially made some change. It re-engineers you internally, and also helps you in the investing, right? Because it kind of teaches you how things are impermanent. Everything remains same. So while things remain same, but things are always impermanent. So how do you deal with things which are impermanent in our life, right? And that is a very big sort of learning. And it more importantly, while knowing intellectually a lot of things, we are not able to implement in our life. So this techniques teaches us to implement that experientially rather than being intellectually aware. And this journey from intellectually being aware to getting implemented in our life is what this technique is all about. And I think it's one of the best. I still try to kind of get better at it, but it's a long journey. It's never one day. So it's a great one and it's strongly recommended.
It's a start nonetheless. Nikunj.